Hey guys, it's Stephen from HDQ Accountants, and I'm going to cover some basic principles about companies that all business owners should know about. So first of all, what is a company? A company is a business structure that is used with limited legal liability, has the ability to hold assets, sign contracts, and transact, and is the most commonly used business structure between small to medium businesses. We've all heard of the term shares. What are shares? Shares basically represent the ownership of the company. So say if there was a private company limited by 10 shares and I owned 3 shares, that would mean I have a 30% ownership in that private company. So what about taxation? The taxation for private companies at the moment is 25%. In Australia, if you're a small business operating through a private company structure, you actually have a flat rate of 25%, which is extremely attractive as this has fallen over the last couple of years from 30%. So say if you're a sole trader, you're earning over 180K, any additional income that you earn is actually taxed at the highest marginal rate at 47%. So would you rather that extra dollar be taxed at 25% and you can use the funds to reinvest in the business, or would you rather pay the 47% and then reinvest into the business? The next concept is risk. So when you transact through a private company, you have limited legal liability because the company itself is separate from you and it's a separate legal entity. So this means that if you had a great idea, you started a business and it went down, 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 and you owe a lot of people money, then at least the liability is limited to the assets of the company rather than your personal assets. Another reason why you would start a company is that you want to go into business with a friend. So often, if you guys set up a partnership, you guys have unlimited legal liability, and you also have something called vicarious liability, which means that if one partner does something wrong, that's a shared responsibility with the other partner. So often it's better to transact through a private company with 50-50 ownership, represented by 50-50 ownership in shares. This gives you the limited legal liability, but you won't be able to access any negative partnership loss distributions, because as the business is in a private company, the losses would be carried forward to offset future profits in the company, rather than being distributed and offsetting other income to the partners. Another useful tool using a private company is financing, or getting another partner on board. So say if you wanted external investors, you could sell a part of your company represented by shares for some additional funding to expand and grow your business. If you wanted to get on an additional partner, you can issue them a number of shares. And there's also a number of flexible ways where you can control the ownership of the shares. You can issue shares, you can sell existing shares, you can transfer them. It's just up to the discretion of the business owner. But often with private companies, we see it's 100% owned by one person or entity, just because it's better to have 100% control, especially if it's a small business. That way you can have your autonomy and you don't have to discuss any other decisions with other participants or investors, because that could heavily restrict the way that you want to operate your business. So how are profits taken from a company? We all know if we bought some blue chip shares, say we bought some shares in Telstra, that would give us something called dividends. And the dividends would come with something called a franking credit. So what are these two concepts? A dividend is basically a payment to shareholders that comes out of retained earnings. So how do you pay yourself as a director and sole shareholder of a private company? So there are 3 main ways. The first way is paying yourself out a wage or a salary. The second way is paying yourself a director fee. And the third way is to pay yourself from after-tax profits, which are called dividends. So the first 2 are pretty straightforward. The third way, where we should be quite familiar. Say if you've ever invested in the stock market, say you bought 10,000 shares of Telstra every half year they pay you a dividend based on the number of shares that you hold. Those are called dividends. And they often come with something called a franking credit, which represent tax that the company has already paid. So for example, if we took a $75,000 dividend from the company, it would come with a $25,000 franking credit representing the tax that was already paid. So the director would take that $75,000 plus the $25,000, he would pay tax on the $100,000 at his marginal tax rate, and he could claim back a franking credit of $25,000. Another benefit of the private company structure is the flat tax rate. So say if you made $500,000 in net profit, you only needed $100,000 to survive. You pay yourself out $100,000 as a salary or wage, and the remainder can pay the flat tax rate at 25% and actually be reinvested into the business without paying the higher rate individually. So this is extremely attractive for new business that wants to reinvest, and you get a lot more funds as working capital for your growth and in further investment. So we've covered a few concepts about private companies in Australia. So if you're still unsure whether the structure is good for you, whether your tax planning is done right, whether your tax structuring is done right, please feel free to reach out to us and we'll help you at HDQ Accountants. Thank you.